earlier in the year, especially starting in April, there was just a lot of uncertainty. No one really knew the rules of the game, and really just talking about tariffs and et cetera. And so at the end of the day, though, U.S. investors, our perspective is we got to focus on real estate's long term. You got to think long term. Good thing about the U.S. is we have elections and things change, et cetera, and you can only have so many terms as a president, et cetera. So, and I think people are starting to realize that there's a lot of talk, but it might not be as bad. Things don't always end up. It's still kind of shifting. So I think folks are feeling comfortable that, all right, it's not perfect clarity, but from a commercial real estate perspective, again, there's a good entry point. We're gonna, I think the logical, consensus view that and the perspective you have to have right now is, okay, GDP growth might be slower. It's not gonna, blow it out of the park right now, and there's gonna be some inflation risk you got to keep your eye on, in the labor market, employment. But there's still opportunities to get in, and so you're not gonna have maybe that V-shaped recovery. But as an entry point, again, if you're thinking that long-term perspective, fundamentals are still generally strong. That supply is starting to diminish. One of the other strengths in terms of the opportunity set is forward supply. Because of interest rates and maybe some uncertainty on development, it's a lot harder. So you don't have a lot of new product coming. So that will restore pricing power to owners of current assets that are buying today. So that's kind of the underlying opportunity set. But it just comes down to growth opportunity. I mean, the U.S. is a large liquid market, and liquidity and growth market. I would say the tone has changed from when I was talking to investors, both domestic and Europe, from April through kind of earlier in the summer, where it was, what is going on? This is, I don't really want to touch the United States, et cetera. I need to focus on my home market for the European investors. And the more recent, the last two, because I was out here in September as well, I think that's thawing. I think global investors are still realizing, okay, when it just comes down to growth, the U.S. is a growth market. It's liquid. We can't ignore it. And okay, now that we've seen how things have played out since all of the talk, et cetera, earlier, right, it's not all going to come to fruition. There's been some news still challenging kind of the legality of tariffs, et cetera. So investors are realizing, okay, long-term perspective, fundamentals are pretty good. It's a good entry point. It's a tangible asset. I can get cash flow, I can get appreciation. And then, you have to just look at the equity markets today, again, more holistically for investors who are looking at everything beyond just real estate and saying, okay, are we a little bit toppy? Everyone's leaning into some, a small handful of stocks are really driving the stock market. So I think folks are thinking like,
the last couple of months have been mad.
Yes.
In terms of the growth there.
Yeah.
And so what the kind of the weighting effect in terms of portfolios and how they're structured, is that kind of what you're alluding to in terms of like over allocation to one sector versus another?
Yeah, a little bit. And upside versus downside, right? I mean, okay, if you're looking at valuations in the traditional equity markets where they've gone, is there how much more growth, or is there more risk that there's going to be a correction versus, okay, commercial real estate's gone through its correction. There should be some upside. Now, it's not going to be the explosive, AI-driven or technology-driven type of growth, but it's going to be steady growth with income appreciation, and there's value to having that in a portfolio. And I think folks realize that, all right, if I can get in now, I mean, history shows, if you look at the data, after major dislocation events, investors who come in just from a vintage perspective, in the first couple of years after these events, before there is perfect clarity, right? It's those will outperform because once that green light's on, the capital comes in. So the cycle that, as I view it, it's the C's, right? Okay, certainty. You need some certainty first. But once you have a little bit of certainty, that leads to conviction, from investors, which then leads to the capital coming in. And that's a big thing that I'm seeing over the last 2 months, both domestic and global. Investors are picking up their pencils again. They're looking and saying, okay, I've gotten through my priorities in 2025. Maybe it was private debt, infrastructure, data centers were huge. I've made my allocations. Wow, real estate is looking really attractive, particularly value add. If I'm going to be in a slow growth environment, higher interest rate for longer environment, well, I'm not going to create value by just having outsized market rent growth or cap rate compression. That was last cycle's game, right? I need to come down to asset selection. It's good old-fashioned real estate. I need to pick the right assets. I need to add value to be able to generate, grow NOI to be able to generate returns. And and active management, like we were talking about. I can't just set and forget. I need to constantly be managing my asset. So that capital is starting to see all of that. They come in, and what does that do? That creates competition. Everyone's now starting to compete again, which then leads to compression. That's sort of the cycle. And right now we're in that that mid phase where, okay, people are having a little bit more conviction and certainty that now's the time to come in. I think capital's picking up its pencils and pretty excited about next year that, more, but I don't think it'll come rushing in, which is great for, again, those who do have the conviction and capital to invest now, to get ahead of before that green light comes on and, the horses are let out of the gate.
So just run me through. Is there 5 C's? And what are they?
It was certainty, conviction, capital, competition, compression.
And then the 3 A's are? Asset
selection, adding value, and active management.
Love a framework. Love a framework. And I'm sure the people listening to this as well will be writing that down furiously.